Okay, let's look at trade payables. Let's look at trade payables. So with trade payables, what we're really saying, we're looking at the movement here, is let's look at exactly the same point. You have your trade payables, you have an opening balance. It's exactly the same principle. Opening balance, you pick a number. I'm going to start off with 10, and that's a closing balance of 2. Closing balance of 2. So your statement of financial position will say 2005, trade payables 10, 2006 2. Now, by the way, if you see, for example, like this is operations. If you have loans, once you see a fall, for example, if this was a loan, this is cash flow from financing for a loan, for example. 10 to 2 literally means you paid 8,000 of your of your loan. So once we're talking about once we get to cash flow from operations, from then onwards, it's just literally, well, that means 8 went out. So you deduct 8 from whatever because it's not looking like the bank, right? We're just trying to get to the point of, can we mimic exactly the bank behavior? So again here, let's just say you bought some goods here. I have here purchases. You'd bought, say, £50,000 worth of purchases. So debit purchases, credit trade payables. So it must mean that if this was the case, that 60,000, it means you must have paid out 58,000 out of the bank. So the bank must have come to 58,000 in the end. So what we see here is in terms of adjustments, is that your profit for the year already includes this deduction of 50,000 so far, right? So far it includes, because of course profit for the year is revenue minus purchases. So if it already includes this deduction of 50,000, what we're really saying, actually what happened was that cash, actually 58 actually left. So you've put through 850 so far, so you need to put through another 8 to kind of complete it, right? You need to get it from 50 to 58, which is why when we do profit from operations, then we add depreciation, add loss on sale of asset, deduct gains, do the thing with trade receivable, whatever it's up or down. Same thing. When you see a fall in when you have a fall in trade payables, we're seeing a fall where we're adjusting by the theory, the concept behind it is we're increasing that expense. We're saying it's not really 50. For cash, we need to reconcile it up to 58, so I need to deduct another 8 to get it from. So technically, this should be 58 if this was cash. So we deduct 8, right? And we literally reverse. It's exactly the opposite for the opposite, where if the trade payables had gone up, I'm just going to call this 12, just for the argument, just say, by 12. So if this had been 12, and for example, we had bought goods worth 50, this would be 60, and this would be 48. So, right? I mean, so therefore, in that regard, here we have trade payables going from 10 to 2. We say things like, oh, it's gone from 10 to 12, so that means you've received another 2 grand. Think of it like a loan. So money's coming in of another 2 grand. There's several ways of thinking about it, but this is the theory. So what we're saying here is that, well, you've hit yourself with an expense of 50. Really, the cash that went out was 48. So therefore, to reconcile this, I need to add another 2. So to your whole schedule, you will add 2 grand to bring to reconcile this 50 to 48. And that's how we deal with trade. That's how we deal with trade payables. The one I think you just have to kind of accept, forgive me, is inventory, because it's really closing inventory, and that works its way through cost of sales and all of that, and it can be a little bit. I mean, I'm yet to find a nice double entry way of explaining it, but the principle really is this: that if inventory has gone up from, say, 2005 to 2006, if inventory has gone from 10,000 to 15,000, we just say straight away that you have spent more money on inventory that year, and therefore money has gone out. If inventory has gone from 10,000 to 5,000, we argue that you have sold inventory, and inventory has fallen, and therefore money has come in. And that's it. That's all I'm going to say about inventory. I could do the double entry, but it's long-winded. And every time I do it, I still don't really see the point, because I have to go through cost of sales and all of that. So it doesn't really. Inventory, we just have to please just accept that is the situation. And that's the cash flow movement there. That's that. Right. The next thing. So that's cash. So therefore, when I come to, so let me show you the full schedule of my cash flow from operations. My cash flow from operations is telling me that what you want to do is you want to start with profit from operations. Now, this is important, this idea of profit from operations, because you might have profit for the year, but you need to go back to profit from operations. That's important. So you have profit from operations. And yes, you have that. Then you need to, again, like add depreciation, add loss on sale of assets, deduct gain on sale of assets. Now, of course, trade receivables, you look at it, right, and see the scenario. If trade receivable has gone down, so for example, if trade receivable has gone down, it means that money has come in. So add that. So you add. And if trade receivable has gone up, deduct. Right? Because if trade receivable has gone down, technically it's gone from 10 to 6, so money's come in of 4. Add. Trade receivable has gone up in a way you've given credit, so you deduct. So add here and deduct. Trade payables. If trade payable, and I think you should always think of it that way. If trade payable has gone down, because that's sometimes the easy one to see. If trade payable has gone down, so if you owe 10 and now you owe 4, it means that you've paid out money, so deduct. And if trade payable has gone up, it means you borrowed more money, and so you add. Right? And that's how we do it. And then finally, the last thing in this batch is inventory. And inventory, if inventory has gone up, it means you've bought more inventory, so money's gone out. If inventory has gone down, it means that you have received money and money's come in. And that's really your cash flow from operations. After you do this is recorded, so I can erase this. So once you've done your cash flow from operations, you will deal with your finance costs. So you're there. Cash flow from operations is really the bit. Once you do that, we deal with finance costs and taxation, tax paid, and finance costs typically paid. When I say typically paid, the finance costs are usually, it's just double entry again, tax paid. So I need to do, so from here onwards, I'm looking at the double entry to see what was actually paid, So for example, you will have an opening tax liability, you will have a closing tax liability, and you would have the tax expense. So for example, opening tax liability is what it is. You now have a tax liability for the year, so debit tax expense here, tax expense. Then you will get given a closing down figure, and then you will find what that difference is. So everything from here is literally double entry. It's like, okay, I have an opening balance, I have a closing balance, I need to find the double entry to find out what the tax is paid, literally from everything hence onwards. And hopefully we'll see that as we do examples in class. But I'm just explaining the concept really here. What I'll do in this video as well is I will just do the last two things, which are important, and I will use an example. And this is, I'm going to now look at cash flow from I'm going to go to a screen to show you what's happening. I'm going to do cash flow from financing because that's the simpler one first. And it literally is, I'm literally looking at the events. Look at this here. Cash flow from financing, I'm looking for loans. So look at this debenture here. Here I can clearly see that which is one? This is not 2009. 2009 debentures of 27,600. You start off with this, and then you end up with this. So literally, it means that over the period, I had 27,600, and then I borrowed some more money, so money came in. You're literally looking. You can do the double entry as well, just to see if there are any notes, but there are no notes. Nothing else happened with those debentures. So that's the money that came in, literally 32,700 minus 27,600. As simple as that in terms of my loans. That's cash flow from financing. Then I look at my equity as well. Look at that. I started with 48 and I arrived with 60. Yeah. 40 plus 8, 48, 50 plus 10, 60. So I issued some new shares. How much? Well, it must be 10 plus 2, 12. So I had 12,000 come in as a result of my raising new money, and I had 32,700 minus 27,600 come in terms of cash flow from financing, right? And that's what happened there. Right, and that's that. And that literally is, those two are quite straight. Cash flow from financing are pretty nice. So just basically add in money coming in from loans, or you might have paid, just look at that, or money coming in from equity, just look at that and look at those areas. I mean, I would say you want to go through everything and don't get bogged down in just cash flow from operations. There's marks everywhere, so get all the marks. The last one that's important to look at here is this business of cash flow from investing, and it is just an experiment in double entry. So let me just take you to the example here. But you will see that I'm not doing anything you don't know how to do already. It's just double entry away. Let's look at this picture. Here I want to see what cash flow happened as a result of my non-current assets. And I start the year with 50,000, I end with 124. But I might have some disposals. Just an exercise in double entry. And look at what I have here. So this is my picture. I'm just going to snippet this out so that you can see if I want to calculate what cash flow came in from what I bought in the year. I need to sort of look at this picture here, right? And let's just see what happened here. So let me just do the double entry. That's all. It's all double entry. So I start off, I have here asset and accumulated depreciation, all an experiment in double entry. So I have here asset of 68,900 and accumulated depreciation of 18,900. That's what I have, isn't it? 68 in this. So I can see I have a carried down figure here of 163,600, and I have a carried down figure here. This is accumulated depreciation, of course. A carried down figure here of 39,500. Okay, let's go. So what happens? So during the year, it says that a non-current asset with a cost of 20,000 was sold for 10,000. So the cost of 20,000, I'm just going to change. I can change my pen color here. So got rid of it for 20,000. The question is, what was its accumulated depreciation? So it says the accumulated depreciation of the asset was 4,400. Well, I have to get rid of that as well, right? Because here's my disposal account. My disposal account is 20,000 here and 4,400. I mean, I sold it for 10,200. So my bank account is showing 10,200. So I've made a loss. And that loss, if you like, goes to my income statement. Remember, I have to add that loss back when I'm calculating my cash flow statement, right? So my loss here, this is 14,600. So my loss is 5,400, and that closes out. That's my loss on sale. So I'll just have that as loss on sale. I'll just keep it here. Loss on sale, 5,400. I know I'm going to add that back when I'm doing my cash flow from operations. No problem. That's fine. That I needed that for that. But let's focus on this here. So that's what I have here. Then, yes. So really and truly, I now know what typically it should tell you what your depreciation is for the year, right? You will have depreciation expense. Let's see if they give that to us here. Depreciation expense for the year. I suppose I could work it out, but sometimes they give it to you as well. So it will be what it, right. So I'm just going to have to work that. That's just going to be whatever is in there. So what am I saying here? So it means, right, that for you to have had an opening balance of 89,000 and you got rid of this 4,400 and you have a closing balance of 39,500, you must have had depreciation for the year. I mean, sometimes they give it for you to confirm of, this is the carry down figure, right? This is what this is. I'm going to add these two together, right? So I'm going to have 0, 0, 4 plus 5 is 9. 4 plus 9 is 13, and I have 43,000, so 43,900. So I'm going to have depreciation expense of the difference, really. And this is a nice round number here. So this is 13 minus 8 is 5. Yes, so 25,000. So my depreciation must have been 25,000, right? Because that's how we do this, right? Debit depreciation and credit accumulated depreciation for the year. That's what happened. Started the year with this, disposed this, depreciation put through 25,000, and that's how you have a carry down figure of this, isn't it? Right, and so that's my so this depreciation expense must arise as a result of me buying some new assets as well. So let's just look at it. So what does that mean? If that's my carry down figure here of 163, yeah, so it means this is 183,600, right? It means that, I started the year with 68. I got rid of 20. For me to have a carry down of 163, I must have bought assets in that period of the difference, which is 183,600. 113,600 minus 68,900, which is 114,700. I must have. There's no other way this would balance. So that's the cash flow from investing. How much went out, but this came in. So 10,200 came in, but 114,700 went out. So my cash flow from investing, when I do my heading, you will see that it'll have cash flow from money coming in, 114,700, but it'll also have, this going out, and it'll also have 10,200 coming in. So that's kind of how we do it. This experiment here, this double entry process of having asset, accumulated depreciation, disposal, you want to be happy with it. It's double entry. I'm sure you are, but it's central. It's the last bit of the jigsaw in dealing with this. Right. And apart from that, everything else you will meet, of course, at this level will be double entry, other movements, but you're always doing the double entry because you can see what I did. I had to work it out. I have an opening figure. I will have a closing figure. I might have some movement. I have to work out the difference. That's all you're doing in this chapter, working out the difference via double entry and then putting everything in the right category, which comes with a bit of practice. Awesome.